Hello and welcome to Sectors Up Close. I'm David Pollard. Today we're talking healthcare and my guest is Keith Gangl, Portfolio Manager at Gradient Investments. Resilient to recession and market downturns or undersold and overpriced? The investor debate over the healthcare sector is robust. Its fans point to a history of strong returns when inflation skyrockets. Detractors point to a risk of underperformance should a secular long-term bear market evolve and say some valuations look high. Not to forget, of course, that this is a sector under intense regulatory and social pressure amid the scandals over opioids, the crisis over COVID and the political debate over Medicaid. As for performance, the S&P 500 healthcare sector is down just under 8.5% year to date, with a PE of just under 21 and a dividend yield of just over 2%, both almost exactly in line with the overall index. For fund investors, there's the Spider Healthcare Select Sector Fund with a market cap close to $40 billion and a range of big names across pharmaceuticals, healthcare providers and services and others, though over half of the fund allocation is in the first two big categories. Well, joining me now to look at the sector in more detail is Keith Gangl, Portfolio Manager at Gradient Investments. Keith, thank you so much for joining us today. Let's look at the big picture question first of all. At a time of a slowing economy but rising inflation, why healthcare?
We like healthcare. Healthcare is a non-cyclical area and tends to do well even when the recessionary environment. So as the economy slows down, your need for healthcare prescriptions, healthcare treatment, that doesn't go away. Unlike other parts of the economy, if your budget's feeling a little pinched, say on like consumer discretionary, like in a restaurant or apparel spending, if the economy slows down, you'll pull back your budget. Those are areas that get hit a little bit harder than where healthcare does in general. Again, with healthcare, with economy slowing down or potentially slowing down, the need for drugs doesn't go away. The treatment doesn't go away. This is a good, consistent growing area, consistently growing their earnings as well over the last decade. So we like this space going forward.
Let's move on to some of the risks facing the sector. Obviously, regulatory scrutiny and social pressures are two big risks, especially in the wake of some of the very negative headlines that we've had in recent years. How would you describe those risks and what are the other risks?
Yeah, the biggest risk that we focus on is regulatory risk. Now that's going to impact both med tech and large cap pharma. For example, if a drug that gets approved and then gets pulled off the market, that's negative for the stock. Same thing with med tech devices. If devices are not approved, that's negative for the overall stocks. But we like to have large cap pharma, large cap med tech companies because they're more diversified. And then if one drug gets pulled from the market or it's proved it's unsafe, that won't impact the overall brand. Same with a med tech device. If a device gets pulled from the market, there are many other devices to rely on to keep their growth rate going forward.
Clearly, there are multiple subsectors to this space, which makes it quite hard for an investor to navigate. What do you think is a good starting point? Where should an investor begin?
The two areas that we like to focus on like best right now going forward are healthcare insurers and med tech device companies. These companies both are consistently growing companies. They generally grow their EPS 10% plus. They do well in both the recessionary environment and when the economy continues to do very well as well. So those are two areas we like. Within healthcare insurance, the two names that we like to focus on are United Healthcare Companies and Cigna. United Healthcare is one of the largest insurers in the US and the world. And so that's half of their business. The other half of their business is called Optum, which basically Optum has a PBM as well, which is a pharmaceutical benefit management company. So it helps lower drug prices going forward. And they also have technology that also lowers drug costs going forward. Now in Cigna, that's another good company, grows 10% EPS plus, trades 11 times, a solid grower there. Now, if we shift over to the medtech side of things, the two names that we like are Dexcom, which is diabetes play. They're in the medtech device where they do glucose monitoring. So that's a fantastic market. Unfortunately, diabetes in the world's growing. So it's a good place to be playing in. This is a high grower growing 20% plus. Outside of the US, they're growing 30%. So it's a fantastic company, a good growth rate. And that's not going to matter whether the economy is growing or slowing. This company to do well. And the last name we like there is Boston Scientific. This is a very diversified large cap med tech device company. They grow their EPS and earnings per share growth at 10 to 15% plus for next several years. They have a strong balance sheet and they can also do some M&A activity. So again, this company will do well both in a recessionary environment and when things pick up.
Now, farmers, as I mentioned, they're the biggest single subsector, and they have disappointed investors over the last downturn. Why do you think that is? And do you think things could pick up for that subsector?
We do. We like pharma, but we prefer some of those other areas. The two names that we like in pharma are J&J and Bristol Myers. These are relatively cheap names. They're trading at anywhere from 10 to 13 times PE multiples, which is cheap. In actuality, if you look at year-to-date performance, these names actually outperform the overall market because, again, as people are worried about recession, a large cap pharma is considered a defensive area, so they'll flock into it, and they've actually outperformed on a year-to-date basis. Now, for the last 6 weeks, when the market's actually picked up, they've actually underperformed because they've sold off these names. They have to get a little bit more aggressive, a little more exposure to maybe the economy being into a shallow recession or actually picking back up. That's the case. Large cap pharma tends to underperform in up markets, but they'll do very well when people are nervous about things. So large cap pharma, again, it's a place in your portfolio, but we like other parts like insurers and med tech devices.
The big overall question is performance. What sort of returns can we hope for and over what sort of time horizon?
Yeah, when we look out for the next year, we like healthcare. This is one of our favorite sectors of the overall market. Again, like I said, there's parts of healthcare that do very well if we go into recession or a shallow recession. And there's other parts of healthcare that can outperform. As a whole, we would expect this to outperform the overall market. So we expect the market to kind of grind higher into this year and go higher next year. So we'd expect this space to be an outperformer going forward.
Okay, Keith Gangl, Portfolio Manager at Gradient Investments. Thank you so much for your time today. And that is your roundup of the healthcare sector. I'm David Pollard, and this is Reuters.